So great. So we are going to go ahead and get started. I think we've kind of gotten a bunch of people, and
Sure.
the more we wait, the more people get used to us waiting. So I'm going to take over for Kim today. I've been watching closely for a while and see if I can do it, replicate it if possible. But we're very happy to have Adam Spencer here to tell us about policy effects of international taxation on firm dynamics and capital structure. And as usual, we'll treat this as a regular seminar since it is. Take it away, Adam.
Great. No, thanks. Yeah, thanks so much, guys, for having me here. It's a privilege to be able to present my paper today. So, as I was kind of saying to George a bit before, so the paper is kind of I'm about to wander into the wonderful world of responding to referee comments the last kind of 3 weeks or so. So I, some parts of the paper will kind of change a little bit, not too much in terms of the model, but kind of some stuff in terms of the calibration and the quantitative stuff. But I guess I'll flag that to you guys when I get to it. Okay. All right. So the research question that I try to answer in this paper is how do tax reforms that are targeted at multinational firms affect domestic productivity, economic activity, and welfare. Okay, so these are tax reforms targeted specifically at firms that undertake FDI. I want to understand how they affect the domestic economy of the country in which these firms are incorporated. Okay. And as George was saying, guys, please interject at any time. Any comment is very much welcome. Okay, so to kind of motivate this question, so a couple of examples. So the most kind of prevalent example is this Tax Cuts and Jobs Act that you guys had a couple of years ago now. And one aspect of this Tax Cuts and Jobs Act involved removing this so-called repatriation tax. And this tax is basically a rate that the U.S. government used to levy on the overseas earnings of U.S. firms. Okay, and then some more kind of recent examples. So the OECD, the last kind of couple of years or so, have put out a lot of kind of proposals that thinking about curbing tax evasion by multinational firms, and they've kind of been pushing for this kind of coordinated approach to corporate taxation and a push towards more of a sales rather than a production-based method for taxing multinational firms. Okay, so you don't have to look too far to find examples of these types of reforms, and so this kind of given how large multinational firms are and how much they kind of are involved in markets around the world, it's kind of important that we have some kind of framework that we can use for evaluating these types of reforms. Okay, so what I do in this paper is I develop a quantitative model that can be used to evaluate these types of tax reforms on the macroeconomy. And the model is going to feature three main kind of features. So one is going to be heterogeneity and selection effects in terms of firm dynamics. There's going to be dynamics through firm level capital accumulation and firm level adjustment costs. And I'm also going to have financial frictions. Okay, so the story with the paper is that after I kind of develop this general framework, what I do is I kind of discipline it with US data and then apply it to this US policy reform, removing the repatriation tax. And then once I've done that, what I do is I shut down some of the features of the model, in particular the feature of dynamics and financial frictions, to kind of get an idea about what the quantitative significance of these unique features of the model are. Okay. All right, so I'm going to give you a preview of the results before I jump into the model. Before I do that, I'm going to talk a bit about the institutional stuff for this US reform and then try to talk a little bit about the intuition for what kind of effects or what mechanisms are going to drive domestic US effects in the context of my model with regard to this particular policy application. Okay, so let's very quickly think about an example. So think about, say, IBM incorporated in New York. Say that we're thinking their British subsidiary over here across the pond. And let's assume that the domestic corporate tax rate for the US is denoted by tau pi, and the corporate tax rate for the UK is going to be tau pi star. Okay, so the story is that prior to this US reform, so pre-January 1st, 2018, the idea is that when the UK subsidiary generates these earnings in Britain, they're going to pay taxes to the British government. And it wasn't until the firm repatriated these earnings back to headquarters in the United States that you would owe the second layer of taxation that you would pay to the US government. Okay, and the idea would be that prior to the reform, this rate that you would be paying, this repatriation tax, is going to be this difference between the US corporate rate and the overseas corporate rate that you'd already paid. Okay, so this is the pre-reform scenario. And then post-reform, this aspect of the Tax Cuts and Jobs Act that I'm evaluating is this removal of this tax. Okay, so obviously post-January 2018, you're still going to pay taxes to the British government on these earnings, but you're no longer paying taxes to the US government on your overseas earnings as a US firm. Okay. So let's think a little bit about intuition here. So what are the main channels that I'm kind of getting at here in the context of my model? In particular, let's think about this question. So did the US, reform increase or decrease domestic production? Okay. The answer in the context of the model is going to be that it depends upon selection effects that are going to move in both directions. So kind of upward pressure and downward pressure. And the overall impact is very much going to be a quantitative question. Okay. So in terms of the trade-off, okay, so this reform, so taking away a tax on being a US multinational is going to increase the value of being a multinational, okay, both in kind of the absolute sense and also in the relative sense when you think about different modes of kind of servicing overseas markets as a US firm. So in terms of the kind of negative for domestic production in the US, more multinationals and fewer exporters is going to kind of lead to this offshoring effect. Okay, so this offshoring effect, fewer firms producing in the US and more firms undertaking FDI to service a foreign market. Okay, and this is kind of one of the things that opponents to this reform were kind of worried about back in late 2017. But on the flip side, if you're kind of increasing this value to being a US multinational, the idea is that in the model, US firms that kind of enter into the industry have the option in the future to kind of endogenously change their status to become a US multinational. Okay.
So Adam,
yeah,
may I ask a quick question just to make sure I understand the change in the tax law? So I understand how you explained it.
Yep.
The change would only have bite if the foreign corporate tax rate is lower than
the US one.
The US one.
Yep. Yep. Absolutely. Yeah. So if that wedge is going to be positive, and indeed the wedge, at least looking at kind of the pre-reform rate for the US, this 35%, it was pretty much a positive wedge for every country in the world effectively.
But didn't they also lower the corporate tax rate?
Yeah, sure. So, I mean, I'm not going to kind of think about the more general kind of drop in the tax rate. I'm just going to focus on this one kind of aspect. But yeah, indeed, one thing that one could do also is think about, dropping the tax rate and kind of trying to isolate the two different effects. But for now, I'm just going to kind of show you the effect of setting this wedge to zero. Okay.
Under the old rate.
Yeah, exactly. Yep. Okay.
So Adam, can I just ask a quick question?
Sure. Yeah.
So my prior is that all of this is going to depend upon income and substitution effects on labor supply.
Mm-hmm.
When I cut taxes, substitution effect should make everyone want to work more, and then there's going to be some terms of trade effect between the two locations. Mm-hmm. Are those going to be a key part of the argument, or are you going to abstract from those?
You mean specifically in terms of labor supply, or more generally in terms of changes with respect to extensive margin and servicing?
No, I'm just thinking about labor supply. It seems like those are the first order things, and then this thing about multinationals or not, in some sense, there's a real advantage to having multinationals because it kind of it lowers the effective tax rate, and that kind of increases labor supply in the first place.
So sure. I'm going to abstract from thinking about changes in labor supply for the moment. It's relatively easy to generalize, and you can I have done it in kind of previous versions of the paper. But yeah, basically, I'm going to keep a relatively simple kind of household setup and mainly focus on kind of the effect of the firm dynamics.
Okay.
Okay. So yeah.
Ask a question too. Sure. Why? It's also not clear to me that if there are more multinationals and fewer exporters, then it's not clear to me that obviously decreasing domestic exports kind of depends also on gender equilibrium effects, because the firm becoming a multinational is growing.
Yep.
And so there's also a scale effect. So it could be bigger in the US and it could be actually exporting more. So then the effect of that could be
sure. No, that's true. I mean, and the way that I'm kind of presenting it on this slide is only kind of it's a complicated model. I mean, there's capital accumulation and things like that. So as you said, size is going to play a role. But kind of this is I guess, simplest kind of intuition for the moment, at least, that I want you guys to have in your head kind of going forward. We'll get to kind of some of these effects that you're talking about a little bit later on. Yeah. Okay. No, this is good. Yeah. Please jump in, guys, whenever you want to. Okay.
Well,
all right,
then I'll jump in.
Sure. Yeah, go for it.
So, everything you've said so far, I haven't seen anything about financial frictions. First of all, you can tell us what the financial frictions are.
Sure. Yep.
And everything you're doing right now,
yep,
it could be in a standard kind of
sure, Dean. Dean, you got to yeah, you're getting ahead of me here. I'm very slow.
I know. Well, come on, get to the point.
Yeah. Okay. Next slide.
Okay.
All right. So, and basically this kind of, this positive effect, increasing the value to being a startup, it basically is this kind of business dynamism effect. Okay. So that's going to drive things like higher productivity endogenously. It's going to push up domestic production. Okay. All right. So in terms of the results, so in the baseline where I have, dynamics and financial frictions, what I find is that the business dynamism effect actually offshores the offsets the offshoring channel. Okay, so I get a rise in U.S. goods production of around 0.1%, and I get welfare gains of around 1%, and it's revenue neutral from the perspective of the U.S. government, from the perspective that a lot of these kind of effects that are driven by the business dynamism channel are taxable by the U.S. government. Okay. So then in terms of kind of the features of the model, so when I kind of shut down dynamics, and what I mean by shut down dynamics is think about kind of a static analog of the model, okay, and recalibrate that. So no kind of capital accumulation, but still some of these kind of changes in statuses and things like that. I actually find that the result changes, okay? In particular, the offshoring effect actually ends up being larger than the business dynamism effect in the static analog. And I ended up getting actually that welfare ends up decreasing in the context of the static model, okay? And, we'll talk more about that when we get to the results, but one kind of thing to kind of bear in mind is that in the dynamic baseline model, the idea is that these firms are kind of subject to these capital adjustment costs, right? So the idea is that some of these firms who want to take advantage of expanding overseas to basically pay a lower tax bill, they kind of downsize relatively slowly in the short run in order to kind of minimize on their adjustment costs. So some of these large kind of exporting firms, they downsize slowly before kind of expanding overseas. And so one way that you can kind of think about this result is that in the dynamic model, there's kind of a slower pace of downsizing that when you kind of look at the kind of cumulative effects, ends up kind of, mitigating the size of this offshoring effect. And then lastly, so I say that financial frictions also have this kind of quantitatively significant impact. And in particular, the friction that I'm kind of talking about here in the model is this costly equity issuance feature. Okay, and this is kind of a feature of the model that I borrow from the corporate finance literature. And basically, what this friction says is that if a firm needs to raise more equity financing, so rather than kind of paying a positive dividend to your shareholders for the period, you take more money from them, you end up paying a premium associated with that. Okay, so that's, yeah, Jonathan.
These welfare effects are huge, 1% up, 1% down.
Yeah.
Are these just steady state? Are you taking into account the transition path?
So I mean, like when it comes to the baseline, that accounts for the transition path. When it comes to the static, obviously, it's just going to be kind of steady state changes.
Okay.
Yeah,
so just to give us a point of reference,
yeah.
Before the change, how much revenue was collected from the tax?
I can't tell you the numbers off the top of my head. I should have a slide on that, but yeah. Off the top of my head, I can't exactly remember.
Well, I want to make sure I understand.
Sure.
Are you computing consumption equivalents?
Yes. That's right. Consumption equivalence, that's what the welfare measure is. Yep. Okay. All right. So in terms of so if I shut down this financial friction, so in particular, if I kind of shut down this costly equity issuance feature, then I find that the welfare gains end up being smaller. Okay, so the welfare gains are 4 times larger in the baseline model with this financial friction in place. And the intuition for that is that these firms who decide to become multinationals after the reform, who were not beforehand, they suddenly gain access to this kind of cheaper source of financing. Yeah. Okay, so it becomes cheaper to repatriate some of your overseas earnings in the instance where you may kind of need to issue new equity, which would kind of affect your marginal cost of your activities like investment domestically. And the idea is that this reform is going to kind of give additional kind of increase to the value of potentially becoming a multinational in the future, because in some sense it allows some of these new multinationals, by kind of drawing on these better internal capital markets, to relieve some of their financing constraints in the future. So this kind of gives an additional kick in some sense to the business dynamism effect, and then ends up increasing this welfare result, and indeed the results more generally. Okay. All right. So let's get into the model. All right. So the model is going to be.
Can I ask you another quick question about that?
Sure.
So when you say, I mean, I just want to know what the exact experiment is that you're actually doing there. So you calibrate the model to get this costly equity issuance, and then you set the cost to zero of basically it's free borrowing or borrowing.
Well, equity issuance is free, right? But I set that to zero, the parameters to zero, and then recalibrate it.
Okay. And then have you actually tried to go in the other direction?
Say that again?
Like, have you tried to go in the other direction? Like, what happens if
like
borrow
if you make
it all? They
if you make it like infinitely, if you make it like infinitely costly kind of thing. No, that's
because,
I haven't done that. Yeah, sure.
One might think that starting out, the cost of equity issuance would be kind of high, smaller. I'm just kind of, I know a little bit beyond the scope of things, but you might think that at the beginning they would be high, and as the firms grow, I mean, multinational would potentially have very different costs of finance relative to.
Yeah, absolutely. I mean, I do try to get at that when I recalibrate all of the transitions. So I'm adjusting all of the fixed costs between the transitions of all the different statuses and stuff. And indeed, like thinking about a new startup firm, I'm kind of recalibrating the distribution they're going to draw their productivity shock from, to make sure that you kind of like push back a little bit against the fact that indeed it's going to have an effect on these firms. But no, but I will also try. I'll try doing it the other way as well. Yeah. Thanks for the comment. Okay, so the setup is going to be such that we're going to have two countries, okay, home and foreign. We're going to have discrete time, and the story is that it's an asymmetric country model. So I do this just to kind of keep the problem kind of tractable. So everything's going to be focusing on home. Foreign's going to be relatively reduced form. It's all going to be kind of idiosyncratic risk. There are going to be 6 agents in the model, so households, firms, and government in each country. And then I'm going to, in terms of terminology, I'm going to call the goods made by, or the consumption goods made by home firms, home goods. And then for foreign firms, we'll call them foreign goods. Okay. So it's a big model. There are going to be 9 markets throughout the world. Okay. So there's going to be a big kind of global capital market. There's going to be labor in each country, which is obviously going to be totally immobile. The household in the home country is going to be able to save through financial assets. So there are going to be riskless bonds and shares in the home companies. And then there are going to be these markets for all the consumption goods that are tradable. And then in terms of prices, I'm going to fix the wage to be the numeraire. I'm going to fix a lot of the prices with regard to the foreign country to be exogenous, but I am kind of solving endogenously, one for the financial prices in the home country, and also in terms of the consumption good prices that the home firms are selling in both home and foreign, where the foreign price adjustments are kind of, important from the perspective of, general equilibrium regulation of, things like expansions or policy reforms that lead to expansions overseas. Okay. So the home household problem is just standard. We have kind of, CRA preferences, and they have, preferences over the 2 different types of consumption goods, so home and foreign. And the idea is that I'm going to have varieties, so different varieties of consumption goods for the home firms, but I'm going to assume that the foreign goods are going to be homogeneous. Okay, and then the other parameter here that's important is this beta, because that's going to feature in the home firm problem. So their budget constraint for the home household, it's just going to be spending on consumption. They can save through bonds, save through shares in the home firms. They're going to get some return on their bonds, some return on their shares. they'll get some, return from their labor, and kind of related to what George was talking about before. For now, I just kind of have, fixed labor supply at 1. And then I'm also going to assume that the home government, with all these different taxes that they're collecting, they're going to just kind of distribute that lump sum back to the household so that we internalize, from a welfare perspective, some of these policy changes that might lead to adjustments in government tax collections. Okay, so all the action in the model is with regard to the home firm problem. So in terms of their states, and I'm in the slides, I'm just going to omit things like firm level notation and H superscripts just so people's heads don't explode kind of thing with all the states. But the idea is that your state vector is going to be made up of a capital stock in each of your 2 countries. So if you're a multinational, you'll have a capital stock overseas. You're going to have a debt obligation that you took on from last period that you have to repay this period. You've got a productivity shock, and ST-1, which I'm using to denote what I call your extensive margin status with regard to servicing what combination of markets and how you're kind of servicing the different markets in the model. I'll get to that in a couple of slides' time. So in terms of decisions for the home firms, they're going to choose each period their extensive margin status. They've got a pretty boring static set of decisions, things like labor demand, things like output and output prices to charge. And then we also have these kind of intertemporal decisions with regard to their investment and with regard to the amount that they're going to borrow. Okay. So their objective, the home firm objective, is going to be standard, just to maximize the value of equity in the company effectively, where this D variable here is going to be your period dividend. So if D is going to be positive, then the firm is paying a cash flow out to their shareholders, who are going to be the home household. Okay. And I'm also allowing the firm to issue new equity, so seasoned equity offerings, which would involve a negative value of this D variable. And that's what's going to incur this premium that I'll talk about later. The discount factor is going to be your household stochastic discount factor, which will obviously be equal to beta tilde in the steady state. It's going to be changing over time along the transition. And then this expectation here is going to be with respect to the firm's idiosyncratic productivity and other idiosyncratic shocks. Okay. So your discrete choice framework is going to basically build upon Helpman, Melitz, and Yapel. Okay, so you're going to have 5 possible choices for a given period. You can choose whether to exit, be a domestic exporter or multinational firm, or alternatively, you can also be a multinational offshoring firm, which basically produces all of their goods in foreign and then ships some of them back to sell to the home country. Okay, and these choices 3, 4, and 5 are going to have access to this foreign market as well as the home one, and then exporting and being an offshore is going to involve these iceberg transport costs. Okay, and so the idea would be that if you want to be an offshore, you're kind of trading off this cheaper factor prices, being overseas, relative to the iceberg cost associated with bringing your good back home. Okay, and the way that I'm going to discipline all of these discrete choices, or kind of get the model to talk to the data, is by using this kind of standard sunk fixed investment costs to set up an operating branch, and then period by period fixed costs every period thereafter. Okay. So the competition structure, the firms are just going to, as I said before, they make these different varieties. They're going to be monopolistically competitive and then set their prices, taking their kind of variety-specific demand curve as given from the households. And their technology is going to be constant returns in capital labor in each country. Okay, so the capital stock in each country, you're going to hire labor in each country if you're a multinational, obviously. And just to flag it, I assume that your productivity is going to be the same across all the different branches of the firm, just to keep the state space, tractable. So your productivity shocks are going to be persistent over time. Okay, so the firms are drawing a different productivity shock each period. And that persistence is going to kind of also give you persistence across some of these different statuses. So your capital is going to be subject to these quadratic adjustment costs. Again, pretty standard. That's just going to kind of depend upon the size of your investment relative to your capital stock. And then where things kind of get a bit more interesting again with respect to my model is in terms of external financing. Okay. So I kind of borrow some of these features from the corporate finance literature. So I'm going to assume that the headquarters of any company is able to raise 2 different types of external financing. Okay, so they can borrow through debt, or they can issue new equity. Okay, and the story is that your capital structure, the firm's going to be able to get an interior optimal capital structure that's going to come through this, a trade-off theory type of set of financial frictions. So in particular, I've kind of got these interest tax deductions, which says that as the firm kind of borrows more, they're able to write off more of their tax bill through interest payments. So more interest means a lower tax bill, which makes borrowing relatively more attractive for a firm. But also, if something bad happens, like if the firm gets kind of a low productivity shock and they have to issue new equity, the idea is that that equity issuance is going to be costly. Okay. So as I alluded to before, the firms are going to have this additional state for net debt. So it's going to be, you can think of it as being kind of debt minus cash in the firm. And the idea is that that debt is going to be collateralized by the book value of the firm. Okay, so your borrowing is going to be collateralized by your book value. And for every kind of unit of borrowing that I undertake, so every unit of borrowing, I have some interest payments that I'm making, and I'm going to get positive cash flows in the amount of the tax, the tax rate times these interest payments. And the way you can think about that is kind of like getting a check back from the government in the amount of this kind of interest tax deduction. Okay, and that's going to be a good thing with respect to the equity value of the company.
Oh, can you,
sure,
Adam, can you just go back one? So what are the two, there's two parameters in front of the capitals. So
sure.
Can you say more about that?
Yeah, sure. So so strictly speaking, they're not both, they're both parameters. Like the lambda is going to be your price of capital, which I'm just going to fix in the model as a part of this kind of small open economy setting. But the C, you can think of, I think that's how you say it, C or Xi, that's going to be a fraction. So you can think about that as kind of being like a liquidation value of the firm. And that's something that I'm going to kind of calibrate inside of the model. Okay. All right. So then in terms of this kind of second friction, if the firm needs to, if the firm pays a negative dividend to the owners in the company, so I'm denoting that with this negative E value, the idea is that you pay a premium associated with that. Okay, and that premium, as is kind of relatively standard in the literature, is going to have a couple of different components. So one, a fixed cost, two is going to be a proportional cost, and then three is going to be this kind of quadratic cost in the size of the equity issuance. And the idea will be that the presence of this premium is going to kind of create this intertemporal sense of precautionary behavior on the part of the firms, because on the one hand, if they need to kind of issue new equity this period, it changes, it increases something like the marginal cost of your investment, but the firm also has to kind of worry about the possibility of issuing new equity in the future, which is also going to kind of affect their marginal cost of activities as well. Okay, see how I'm doing for, okay. So in terms of exits,
can I just ask you? I just want to make sure.
Sure, go for it.
Going back to the experiment that you kind of talked about at the beginning, it sounded like you were changing financial frictions. So just to think about you're saying you're going to change these parameters on this slide, and then what are you going to do with the parameter that you had on the other slide, the Xi or whatever?
That I leave fixed. So I'm just trying to isolate the impact of costly equity issuance on the impact of this reform. Okay. All right.
Okay. I mean, it seems like that's another financial friction that might be very important. It's not clear.
Sure. Absolutely. I mean, you could change the C. You could also mess with the interest tax deductions as well. But for what I have at the moment, I'm just kind of studying the impact of costly equity issuance. Yeah. But yeah, point well taken, obviously. Okay, so the firm.
Can I just want to, because I'm just kind of trying to think through things a little bit. So because of this corporate tax shield, you'd like to use debt, correct? If you could borrow at a risk-free rate.
Sure. Yep.
So you want to start with the debt.
Yep.
But that Xi parameter you just had limits how much debt you can take out, right? Depending upon how much capital you have. So you would start with debt, it seems like, and then when this starts to bind, you might use equity.
But the thing is, that's not always going to be the case, right? This thing's going to occasionally bind because of the fact that the firms are worried that if they borrow too much today, you're going to end up having to put too much pressure on equity in the future. So you might trigger the equity issuance cost in the future. So that constraint's not always going to bind in that sense.
No, I don't think it's always going to bind, but
okay.
But you know,
Sure.
it seems so. If it doesn't bind, you would not issue. I'm just trying to think about your decision rules.
Sure.
If it doesn't bind, you would not issue equity. It seems like. Correct?
I think it's going to depend upon the firm's state. So like if the firm is like really rapidly expanding, then I guess probably the story would be that the constraint would probably be close to binding. But the point is like the presence of the costly equity issuance feature also kind of changes their optimal investment, right? So it's kind of complicated in that sense.
Okay.
Yep.
All right.
Yeah. Thanks. Yep. All right. So the firms can also kind of exit the model. So exogenously, also endogenously, if kind of the value of the firm drops too low. And if you exit, you're just going to liquidate the firm or pay your debts, pay a final dividend, and then you're going to leave the model. Okay. So entrants are going to pay their kind of a sunk cost to establish their headquarters. They'll invest and undertake their choose their optimal financial structure. And then next period, they're going to draw a productivity shock from a truncated ergodic distribution for the productivity process that I'm going to basically calibrate to hit the transition probabilities from new entrant status. And they're also always going to kind of start off being a domestic firm to make sure that kind of their expansions don't happen too quickly. Okay. So if I'm an incumbent firm, I'm going to come into the world with my state vector. I draw my productivity shock and my exogenous death shock. I make my extensive margin choice, my static choices, and then my intertemporal decisions. Okay, and I won't talk about the foreign country just because it's not particularly interesting, but I've got basically demand curves for the goods, and I have a representative foreign firm that supplies some goods elastically to the home country. Okay. All right, so let's talk about the equilibrium. So what I'm going to show you quickly before we kind of get into the quant stuff is the recursive formulation for an incumbent firm, just to show you what's happening with regard to the tax. Okay, so post drawing their shocks, the idea is that the firm makes their extensive margin choice, so exit, domestic, exporter, multinational, or offshore, and underneath this decision, there's going to be a whole bunch of Bellman equations. Okay. So each of these different statuses that involve operating are going to have value that's comprised of two different parts. So one is going to be your period dividend for the period. So that's this D variable. And in addition, your continuation value, which is going to kind of feature this stochastic discount factor for the household. And the idea is that the D variable, so this dividend net of issuance costs, is made up of two parts. So one is kind of your cash flows pre-thinking about any kind of equity issuance. And if this firm happens to be issuing new equity, then the idea is that this E is going to be negative, this 1 will light up, and they're going to pay this additional premium associated with that. Okay, and all of their kind of intertemporal choices are going to be made subject to this collateral constraint. Okay, so this slide. Sorry.
Can I ask you a quick question?
Sure, please, George.
So one thing that I understood was you don't have to actually pay the tax until you bring the money back.
Yep.
So these guys are, hoarding dollars in other places.
Sure.
I didn't quite see how that showed up in the problem. As like, is it like a different sort of savings out there?
Sure. Let me show you. Give me 1 sec to try to explain it to you on this slide, okay? And we can talk more if it's not clear, all right?
Okay.
So, this slide has a lot going on just because I've tried to write it such that it kind of captures all of these statuses all at once. That's why I've got these indicators running around. But all the firms that have production at home are going to have this term here. They're going to get some profits from producing at home, subject to the home tax. They're going to invest in their home capital stock and pay their adjustment cost. Now, where the repatriation tax features is if this firm is a multinational or an offshore, meaning that they have some overseas profits that they're generating, this U variable comes into play. And I guess I couldn't call it R because R is like synonymous with interest rate, but this is the amount that the firm's repatriating from their overseas subsidiary, okay? Now this U variable, so your repatriations, they can either be negative, so they'd be negative if the headquarters is sending some money to the overseas subsidiary, which is going to, not really not be subject to any tax treatment. However, if the subsidiary is paying a dividend to the headquarters, meaning that U is positive, the idea is that this repatriation tax comes into play. Okay, so it's going to hit the positive repatriations from your subsidiary, and it's this kind of ugly looking tax term because we want to levy these repatriation taxes on the pre-tax earnings of the firm. Okay, so I divide by 1 minus the foreign corporate tax rate, and I'll show you the expression for this U variable on the next slide. Okay, but in terms of the other things from the cash flow to shareholders, the firms are going to have various configurations of fixed costs. If they're changing dramatically their kind of status, they might be liquidating capital stocks. They can rebalance their debt portfolio and then also get their interest tax deductions. Okay, so there is.
Do the firms have the option of holding cash abroad?
No, fair question. So they can reinvest in like operations. So they can resave through their foreign capital stock.
Through their capital stock. Okay.
Yeah, exactly. Which is like, indeed, it's kind of imperfect. But give me 1 sec. I'll come back to that point. So I should talk through this equation.
Aren't there diminishing returns to that? Whereas if they could just put the money.
Yeah, sure. No, sure. I mean, yeah. Give me 1 sec. All right. So like so there is indeed a savings decision. So you generate some earnings overseas, subject to your foreign taxes, and then you're either going to repatriate what you earn or reinvest it. Now, so indeed, kind of getting to what Jonathan mentioned, ideally you would kind of want to have like a cash variable in there as well. But the thing is, that's going to matter mostly for these firms who are like really large, really big multinationals prior to the reform. Okay, so firms like Apple, Microsoft, IBM, things like that, you'd have them saving up this really large amount of cash, and then they're going to kind of bring it back as soon as you kind of implement the reform. So a lot of my channels are coming through the creation of new multinationals. Okay, and indeed, kind of if you want to think a bit about this, kind of how does my savings versus repatriation kind of framework match up with the data? If you kind of compare the first year subsequent to the reform, if you look at how much firms are kind of bringing back, if you look at aggregate repatriations in the first year relative to the total amount that is overseas, then the model kind of hits that nicely. So it's able to kind of get it like averages in some sense with regard to this repatriation behavior, but it misses out at the top end as you would expect. But I mean, I'll put my hand up and say like it's obviously a shortcoming, but to talk about the channels that I want to talk about, it's the model does a good job, I think. Okay.
Adam, let me just can I just very quickly pick up on that?
Sure. Yeah.
It seems to me that especially when you're talking about these really big firms that have accumulated a lot of cash abroad, they did this prior to this, these reforms.
Yep.
It seems to me that there's got to be some notion of these firms forming expectations over the probability that kind of reform might happen in the future. Otherwise, I can't really see any huge incentive for them to accumulate these big hordes of cash abroad.
Yeah.
Except for the fact that the tax rate on bringing those things back might fall in the future. I think my sense is that if you want to try to understand that, you're going to have to incorporate some sort of forward-lookingness about
absolutely. No, thanks for the comment. Absolutely. And that kind of, that speaks to as we were just saying. I mean, I guess it's like, if you really want to get at the behavior of these really, really big firms, that indeed, this is something that is important to think about, but it's kind of like, in some sense, like I sleep at night, like not stressing like too much about it from the perspective that like, I think if you have these kind of features in the model, it's only going to kind of like bolster or enhance some of these effects that I'm kind of talking about, right? Because in these kind of first years subsequent to the reform, you're gonna have this enormous surge in kind of dividend payments to households and things like that. So it is important. I absolutely agree, but for now it's just something that I'm abstracting from. But the point's absolutely well taken. Okay, thanks. All right, so I got about 20 minutes left. So I'm I'm gonna very quickly finish off talking about the model. I'll quickly talk about the calibration, and then let's get into some of the results. Okay, so the solution concept's just gonna be a recursive competitive equilibrium. So all your agents are gonna be optimizing. There'll be this evolving cross-section of home firms. Your markets are obviously gonna clear, and then I have a free entry condition for the home firms. Okay, so in terms of the calibration, so as I kind of mentioned at the start of the talk, so the calibration part still kind of under reconstruction. Okay, so I've got some comments with regard to kind of, computing some different moments from the referees, and I need to recalibrate the model, but the strategy won't change like terribly dramatically. But one other thing that I'm also doing is kind of an empirical validation exercise insofar as I want to try to understand, do firms extensive margin statuses, does the cross-section actually change in response to tax policy reforms, okay? And thanks to some, helpful comments from a very good referee report, I have kind of a reform that happens to the tax treatment of U.S. exporting firms in the past that I have, a lot of time that's gone past. And I'm basically going to kind of I've checked in the data what that kind of does to export decision propensity. And indeed, it's something that I know the model can match qualitatively, but I've got to kind of map that a bit better to the quantitative stuff. So that's coming in the next couple of months. Okay, so in terms of the calibration strategy, I'm going to discipline the model with data in order to kind of shed light on the issues I've been talking about. One, kind of what is the role of the cross-section on aggregates, what is the role of dynamics, and then what is the role of financial frictions, brackets, costly equity issuance. So the tax rates, I'm going to fix kind of the home corporate rate to be this 35% prior to the reform. And then for the foreign rate, I'm going to take the average over the OECD countries, excluding tax havens. Okay, so I'm not going to tango with tax haven nations. I'm taking them out. And that's going to give you this repatriation tax rate of around 12%. Okay. So in terms of the strategy, I'm going to kind of calibrate these fixed sunk costs and your period by period fixed cost hit transition probabilities in the data. So things like your entry and exit rates, movements between, domestic and all these different statuses, and so on and so forth, which are obviously the important part for the cross-sectional changes. And then in terms of the dynamics, calibrate this kind of adjustment cost inside the model. And I'm going to calibrate these equity issuance cost parameters and the iceberg cost to hit this export intensity as well. Okay. All right, good. Got about a quarter of an hour. So let's talk results now. Okay. All right, so what I'm going to show you here in the experiments is basically 3 different sets of results. So one is going to be kind of the baseline with all of the weird and wonderful features of the model in place. 2, we're going to try to understand dynamics. I'm going to compare it to a static analog that I've recalibrated to hit the fractions of firms in all these different statuses. Then I'm going to shut down the costly equity issuance and then compare with a frictionless analog to see what the story is there. Okay, so the experiment design, it's very simple. We're just going to say we're starting with this pre-reform world with this positive repatriation tax. So this number is 12% prior to the reform. The government's going to say at time 1, we're setting this to 0 going forwards indefinitely, and then we're going to solve for the full transition path to the new steady state. Okay. All right. So this is the picture that basically summarizes what's happening in terms of the cross-section. Okay, so we're thinking here about the fractions of firms, so fractions of US firms that are in these different statuses with regard to servicing the foreign market. Okay, so it's the story is that these red lines just mark kind of, 1, the fraction of exporters in the model prior to the reform and the fraction of multinationals prior to the reform. And then I have these blue lines post-reform. The solid line is your fraction of exporters. Your dotted line is your fraction of multinationals, okay? So there's kind of 2 parts to the story here, right? So as I kind of said before, we're going to have more multinationals and fewer exporters, but it doesn't all happen at once, okay? So what happens here, if you compare the lines, we're getting this kind of drop on impact of the fraction of exporters from around 16% to around 12%, and the fraction of multinationals goes up by around 10 to like 13.5, okay? So we're getting some change on impact, and that's coming partly, 1, through these firms that are entering the industry, but also coming from some of these firms who have kind of intermediate productivity levels who were choosing to be domestics prior to the reform. Some of them now are going to decide to become multinationals. But the story is that the changes that happen, so about half of the kind of quantitative changes in these fractions are coming on impact, and the rest of it's kind of happening over time. And part of the story for that is due to these kind of capital adjustment costs. So if you think about some of these firms that kind of stand to benefit the most from this policy reform, some of them are going to be very large productive exporters, right? And the idea is that some of these large productive exporters are going to downsize gradually over time before expanding overseas in order to kind of minimize on the capital adjustment costs associated with that process. Okay, so we're getting about half of the quantitative kind of reshuffling of the cross sections happening on impact, but also kind of interestingly, we have this kind of dynamic effect that kicks in as well. So this picture summarizes what happens with regard to this, what I call this business dynamism effect. Okay, so what we're getting on impact is this big kind of surge in the measure of new entrants. So this solid line is going to be your measure of new entrants. The dotted line is the measure of incumbent firms. And the idea is that we get this big surge to about 5% on impact. So government just says, now if you're a US multinational, you don't have to pay as much in taxes. So holding kind of everything else constant, that leads to this kind of big surge in the value to entry that basically equilibrates some of these things along the transition. And that kind of gradually drops off over time and settles at about 2% of the pre-reform level, and the kind of drop off is coming through, things like changes in goods and factor prices and things like that. And indeed, the measure of incumbents ends up rising over time. So there are going to be more US firms on account of this entry effect, but it kind of dips a little bit in the short run due to the fact that we're squeezing out some of these kind of unproductive domestics through this kind of selection effect. Okay. Okay, so this picture here shows
Adam,
you, yeah.
Can you go back to that one second?
Yeah,
So
sure.
I would have thought that like a prospective entrant, like, so, I'm a prospective entrant. I don't think about being a multinational when I enter. So I would have thought that, whatever happens to those taxes would have almost no impact on the entry decision. How are you thinking, like in your model, when you calibrate, like how quickly does an entrant become a multinational? Is it like 1 year or 50 years?
No, that's a good point. And indeed, that's something that I kind of is on my to-do list and to checklists in response to referee comments. But at the moment, what I'm doing is calibrating the transitions. Okay, so most firms, when they do kind of start up, are not thinking about becoming a multinational. It's a very small fraction of them that are. And indeed, I'm kind of, it might be like 1% or something like that, that in the first, year after being being an entrant will become a multinational. And the idea is that, I mean, in the model, I need to kind of make sure that I calibrate to make sure that that effect is not overstated, but it is kind of, about 1% in the first year or so that are transitioning. Does that answer your question?
Okay, yeah.
But I mean, yeah, I need to check the life cycle stuff a bit more carefully for sure. Yeah. Okay. So this picture here shows you the riskless rate in the US. Okay. I got about 10 minutes. All right. So I'll show you this picture for a couple of reasons. So one, it gives you an idea of what's happening with regard to financial structure of these US companies when it comes to both their expansions and this business dynamism effect. But it also leads quite nicely into the next slide, which is about the household. So on impact, the idea is your riskless rate's going to spike. It goes up from around 2% in the steady state. It jumps to about 2.5%. In the first year, and that's because of the fact that these firms are issuing corporate bonds in order to partly finance, one, their big surge in startups, and two, also because some of these firms are trying to expand to become multinationals to pay their sunk costs in addition to investing in their foreign capital stock. Part of the story is they're going to basically issue more corporate bonds. So this riskless rate is going to spike, and the idea is that this is kind of where we can see some of these general equilibrium effects having an impact with regard to the household problem. Okay, so the household needs to be incentivized in order to save more in the short run to finance all of these expansions of the firms. Okay, so this riskless rate kind of spikes, and that gives this incentive for these households to save more. So it's not kind of like this uniform increase in consumption. It's not all entirely rosy. There is in fact kind of a pullback for around 5 years or so in the short run. Okay, so there's a decrease in aggregate consumption of the home household in the short run, and then they kind of expand. They get rewarded for that with this kind of things like new profitability of US firms in the longer run. Okay.
It seems like there's a pretty big motive for international borrowing and lending here. I mean, I could do a lot better by smoothing my consumption looking at this picture, right? I mean, I think your welfare numbers could be quite different if you incorporated that.
No, I mean, that's a fair point. Something that I'll think more about this.
Especially if you're thinking about a small open economy.
Yeah, sure. No, I can think more about this. Yeah, that's true. of course, this reason's kind of there to keep things tractable, but obviously your point's, well taken. Sure. Okay. So last thing I'll show you for this kind of baseline set of results. So I've got here what I call cumulative changes. So this is going to be kind of like the NPV, the discounted NPV of the changes in all of these different variables along the transition in the new steady state. So your capital stocks are going to expand. Now I'm going to talk more about that when I get to the financial frictions part. So we're getting this kind of expansion in capital both at home and abroad. The abroad part's obviously easy to understand because it's coming through this kind of extensive margin effect. There's an increase in the real wage domestically. Okay, so this price of US goods is coming down by about 3%. We're getting about a 0.5% increase in productivity, and then we get this kind of snapshot with the revenue neutrality and welfare. Okay, all right, so let's shut down some of the features, see what's going on underneath the hood. Okay, so now I'm gonna show you a table that has these baseline numbers, and I'm gonna compare that to the static counterpart. Okay, so I'm, just a static model, selection effects recalibrated. Let's see what's going on. Okay, so the picture is really different. Okay, so the offshoring effect here is stronger, right? It's a lot stronger. There's a decrease in U.S. Domestic production. We're not getting this 0.1% increase. We're getting a decrease of about 0.9%, and the business dynamism effect is weaker, right? So there's a smaller increase in the real wage, and indeed there's a decrease in tax collections and welfare. Now, part of the way that I did kind of explain that to you in the introduction was because it's kind of motivated by, gradual downsizing by exporters, kind of pushing back some of these offshoring effects to some extent in the dynamic model. But again, another point that was kind of raised by a really helpful referee, and if you happen to be in the audience, it's very, very helpful comment, is that there might actually be, and if you think about an optimal repatriation tax, then it might actually be the case that in the static model, there might be a higher optimal repatriation tax than in the dynamic model. And in looking at these numbers, this makes sense, right? So you're setting it to 0. You're leading to this kind of big offshoring effect. It kind of makes sense to think that the government would kind of tax multinational activities to kind of mitigate some of these things like negative terms of trade effects. So I haven't kind of, next step is obviously to try to, quantify that. I'll see if I can get anything analytically, but I'm pretty sure the story is that this welfare gain is coming because probably there's a higher optimal repatriation tax in the static model than in the dynamic model. But it's, when you work with a model for long enough, you kind of like whisper to it, or it whispers to you. You kind of get a rough idea of what's going on when someone mentions an idea to you. I'm pretty sure this is what's going on here. Okay, so last 5 minutes, let's talk about the financial friction. So we're going to set the costly equity issuance parameters to 0. I'm going to recalibrate the model, and let's see what's going on. Okay. So this first picture, so this is again our riskless rate at home, okay? And it's a very different picture to the baseline model, and it gives you this kind of idea of what's happening with regard to the financial structure of these firms. So now you no longer incur this premium associated with your equity issuance, and so a lot more firms are going to use equity in order to finance, one, their kind of startups, and two, their expansion overseas. So what we're seeing is this kind of much milder expansion in the supply of corporate debt, which is going to have this much milder kind of effect on the riskless rate. But the story, qualitatively is very similar with regard to the household. Indeed, kind of, whether the firm is financing it with debt or equity, either way, whether the firm is financing it rather with debt or equity, it's still money that has to come out of the pocket of the household. So we're still seeing this kind of dip in the short run. It persists for a long time, and indeed this kind of peak that it goes to eventually at the end ends up being a lot milder. Okay, so the last thing that I want to show you guys, let's try to really cement the intuition for what's going on here with this financial friction story. Okay, so
Can I help us?
Sure.
Hey, Adam.
Hey,
so
hey,
I think you're right that the financial friction might be very important, and then the form of financial friction could be also very important, like the bilateral constraint, how you write it down, and also your equity issuance cost. Did you try to see in the data the financing patterns across different types of firm?
That's a good question.
Which type of firm has a easy ways, like which type of firm has higher or lower leverage?
Yeah, no, that's a good question. Actually, yeah, in kind of the recent, I've been getting my hands kind of messy with CompuStat the last few weeks, thinking about this question actually mentioned by a referee as well. And indeed, kind of like multinationals finance themselves differently from non-multinationals, right? So I guess like, as you say, kind of different frictions are going to matter for different statuses of firms. And indeed, kind of just if you look at descriptive statistics, you can kind of see some of these differences. So it is something, yeah, it's a great point, and indeed it's something that I'm going to think about. Okay. All right. So the two.
Hey, Adam, can I follow up with this?
Sure, George. Yep.
It seems like the difference in financial frictions and non-financial frictions are pretty big here. And I'm sort of guided by a couple other papers that have like credit frictions and exporting decisions, and they don't seem to find such. Like when you change a policy, those two models have very different. If you did a financial reform, they'd be extremely different. But so what is special about this format or the type of friction that you're?
Yeah, sure. No, great question, George. So there's a paper that's come out recently, actually. I think it's like Brooks and Davis, I think. I hope I'm not butchering their names. It was like 2020 in the JME, I think it was. And basically these guys say, basically their model is kind of like, it's very, very different in terms of the setup. So the idea is like firms are kind of born, they draw one productivity shock. In their model, equity issuance is infinitely costly, and then it's kind of all about how quickly the firms can kind of expand in response to kind of a trade liberalization. And their story basically is that if you have, they have a collateral constraint, and they say that if the collateral constraint's kind of, backward looking, then it leads to kind of big effects. But if it's forward looking, then you end up getting results that are kind of similar. So it's, the story is very different in my model. It's not so much a story about how quickly do we get to our optimal size. It's more about the fact that the firm's optimal sizes change. Okay, so the story is kind of related to these two first lines here with regard to the capital stocks. Okay, so let me try to explain, or let me try to answer your question, George, by talking about these capital stocks. Okay, so the story is that in my model, these firms are really worried about issuing new equity, right? So they're really, really worried about issuing new equity. And the fact that they might end up having to issue new equity in the future actually induces them to hold back on the domestic front in terms of their capital stock investment. Okay. So the story is that when these firms who are kind of on the margin between becoming a multinational and not prior to the reform, so this is the baseline model I'm talking about here, these firms who do end up changing their status to multinational in the baseline model, they also end up having better internal capital markets. Okay, and the story is that knowing going forward that they have this better kind of internal capital market, so these cheaper kind of finances, these repatriated finances that they can draw on, they actually have to worry less about issuing new equity in the future. Okay, so the reason why this capital stock domestically ends up increasing by a lot more in the baseline model is on account of the fact that in some sense we're relieving the credit constraints of these intermediate productivity firms who end up expanding. Okay, so the story is that kind of with these recent papers you mentioned, in their case it's all about kind of thinking about keeping the equity stuff fixed and then changing the collateral constraint. I'm kind of complementary to them. I'm keeping the collateral constraint fixed, changing the equity story, and in the process kind of uncovering this kind of situation that relates very much to kind of this precautionary stuff. Okay, so yeah, I hope that answers your question, George, but we can talk more about it.
I might come back to it later.
Yeah, no, please do. Okay, and I guess like, give me like 30 seconds more. One other thing I want to mention, so this story with regard to the other side of the capital structure, so with regard to these riskless bonds, the expansion of, so this also kind of relates to your question also, George. We have this other financial friction, which is in fact the interest tax deductions, right? And if these firms don't have to worry so much about issuing new equity in the future, then the idea is that they're going to really try to take advantage of that. Okay, so in the baseline model, there's a big expansion in the amount that these firms borrow because now some of these new multinationals have this cheaper source of financing they can draw on if they end up in hot water in the future. And that induces them to take better advantage of that. And these kind of interest tax deductions, that's kind of more money in the pocket of my shareholders. which feeds back into kind of some of these welfare results. Okay. All right, so I'm over time, so let me just wrap this up. So I mean, this paper, it's all about taxes and multinationals, but I mean, it's more general than that. You can think about taxes, and if you're interested in extensive margin stuff, you can use my model to do that. So I see my kind of contribution as being, two parts. So one, methodological. So I developed this new kind of framework that incorporates, dynamics and these corporate finance considerations. And I've got this US policy application. I think it's kind of a cool US policy issue, but I might be biased because I've been obsessing over it for so many years now. So the punchline basically, so these features out of heterogeneity, dynamics, and financial frictions are all quantitatively significant. And if you want to kind of take some numbers home with you, this 1% welfare gain for the US application and approximate revenue neutrality on the part of the government. Okay. All right. That's about all I had for the present.
Yeah, I forgot I was in charge.
Do you want?
I guess
I've
been watching Kim for a while, so so you can keep sharing the screen.
Sure, sure.
We'll open it up to people just
please.
jump in if they have comments or questions.
Please do. Yeah.
Usually it's a pretty active crowd.
Please, guys, let me have it.
Well, okay. So since I was your supervisor, I'll let you have it. So I mean, you keep on like focusing so much, as Jan and everybody's been saying.
Yeah.
I mean, you have multiple financial frictions here.
Yeah. Yeah.
And I mean, maybe I should think about this all as relative to the this collateral constraint, but you seem not to care at all about the thing you called CASI, right? I mean, this is why I was asking the question about if that CASI, if you could borrow almost freely, given the corporate tax shield, you would want to borrow.
In the absence of the precautionary concerns, you mean?
Yeah, I mean, the question is how, if the constraint is not very tight, there's not really, the precautionary part becomes less important.
What do you mean by less important exactly? Huh?
If I have a very low, take a standard kind of a model, if I'm able to borrow, endlessly,
yeah, okay, I see what you're
I'm
saying.
not going to build up a lot of precautionary balances.
Yeah, sure.
So it seems to me like what your CASI is important for that result.
No. Okay, sure.
And so then just focusing, like only focusing on changing the your equity issuance costs.
Yeah.
I mean, let me put it just as a suggestion.
Sure.
I think the robustness, I mean, a lot of the questions, that were asked, I mean, John was asking, wow, these are big welfare numbers, et cetera.
Sure.
I mean, just as far as robustness goes, it seems like whatever you choose that number to be is going to have a really big impact on stuff.
Okay, sure. No, absolutely. I mean, like, the reason why, though, absolutely, I agree that, like, as a robustness, I need to do something like this. In terms of, like, the experiment, though, I don't know. I'm a little bit hesitant to also kind of mess with that simultaneously with the equity issuance stuff, just because then you're getting into kind of more complicated stuff, like, because that also serves as a vehicle for firms kind of pre-reform being able to borrow against their overseas earnings, which is also kind of important for this save versus repatriate decision for these firms prior to the U.S. reform happening. But yeah, Dean, I agree. Yeah. Thanks.
Yeah, on that point, is it, just to reiterate, like the 1%, as I say, is a big number for this kind of tax. So it'd be good to do a kind of accounting of where it's coming from. When I've seen you present this in the past, I thought it was more from the entry effect. And you're still getting a pretty big entry effect.
Yeah.
I totally share George's question about how is that if firms, presumably on average, a firm is waiting a long time before it becomes a multinational.
Sure.
benefit from this. So how much is that going to be taken into account at entry?
Yeah.
But I'm seeing another effect here is this removing the tax allows multinationals to access foreign funds without paying a tax. So finance domestic investment.
Yep.
So
Exactly.
that seems to be another big effect here. And it would be good just to show us how much more, how many more firms are multinational.
Yeah.
Are they investing?
No, absolutely. It's so as you kind of like alluded to, it's like in the baseline, it's kind of an interaction between what I'm trying to show with that like frictionless comparison is that it's kind of an interaction of the entry effect, as you mentioned, with this kind of financing channel. And yeah, I mean, like the recent round of referee reports that I got were just kind of like, you need to explain this better to us. And that's what I need to work on. Kind of like, you know, thinking about, you know, the life cycle of a firm, or, you know, trying to decompose it, like you say. Absolutely. And I also appreciate, Jonathan, that you've seen me present this a few times now. I'm sure you're getting sick of hearing about it.
Oh, no,
thanks.
I'm understanding it better each time.
Yeah, no, thanks.
So I think, I was just going to say, along what John was saying, I think that that's really important. The financial frictions at the entry time. Yeah, this is probably one of the most important parts of the financial friction. Yeah. And you know that again, that's going to change over the life of the of your firm, right? Yeah. I mean, if you had like equity issuance costs, you know, for entry when you're raising funds, and then equity issuance costs for a mature firm, I would imagine they're extremely different, right? And absolutely. So when you get rid of the friction, at the you know, for new firms, it could have a huge entry effect. Yeah, absolutely. And indeed, like if you actually, like if you set that parameter, if you set those parameters to 0 and don't recalibrate the model, then it absolutely has a huge impact on some of these things with regard to the, you know, the transition of entrant to, or the speed at which they transition to multinational. It jumps like a lot. And so like I am kind of what I do have at the moment is kind of getting at these concerns insofar as to push back against that. I'm truncating the draw of these new entrants from the productivity distribution to make sure that we don't overstate that kind of transition probability from domestic to multinational status. That's held fixed across these two experiments. But indeed, I need to look a bit more closely at kind of, you know, rather than just kind of transitions, also, you know, life cycle stuff a bit more closely. Absolutely. Yeah. Right.
So let me follow up on that a little bit, which was, so in some sense, I had this intuition that if in the frictionless model, I achieve the same amount of substitution between exporting and multinationals and entry and entry, I should get sort of the same aggregate results. And so I wonder to what extent the reason why the models look different is that the marginal, the kind of like the distribution of firm types is very different in those two models, and that if that was the moment that you were targeting, so you know, like the average, you know, if you looked at like the dynamic path of multinational and you kind of match their capital stocks as they're going, so that you kind of have these marginal guys the same. I would have thought that should sort of give me roughly the same aggregate implications and the financial frictions.
Kind of like you guys do, right? In your paper, you kind of try to match the life cycle of exporters. No, absolutely. And that's kind of, something similar to that is also the,
That would help us understand like what's the financial friction. Because the financial friction allows you to speak to like the co-movement of B with K, right? And the frictionless model has like these whole paths. And I just wonder if like the distributions are very different.
No, absolutely. Absolutely. No, that's very helpful. Thanks. Okay. Thanks, George. No,
can I ask? sorry,
Sure.
can I ask you a question about the magnitude of the extensive margin effects? I think, can you go back to the graph?
Yeah, sure.
I think the first graph where you show,
This guy,
yeah,
right?
that guy, yeah.
Yep.
I mean, I think you'd probably agree that some of these changes are pretty large, right? The decline in the measure of exporters in particular. I mean,
Yeah.
falls not quite by half, but by a good, probably more than a third.
Yeah.
Probably there's lots of other stuff going on at this time. It's hard to sort out, what,
Yep.
in the data, how large of an effect we got on this margin from
Sure.
this policy change.
Yep.
I know you spoke very briefly about the validation stuff. I mean, can you elaborate
sure.
a little bit more on, why this
Yeah.
pretty sizable effect is something that we should take away as, like we should have some confidence in?
Yeah, sure. I mean, well, firstly, it's a big change, right? So it's like the firms are suddenly kind of, if they take multinational status, they're saving like 12% out of 35 on their overseas tax burden. So it is like a big change in the tax rate. But indeed, kind of like to kind of get at these comments, it's like I don't have kind of rich enough data to be able to tease out at the cross section what's happening kind of in the first year of the reform, especially given that the corporate rate dropped as well. So there's kind of tons of stuff going on in that sense. But the kind of validation exercise that I do have in mind, or that I had been kind of looking into, is like the US government in, I think it was like 2004 or something, got into trouble with the WTO for like giving tax breaks to exporting companies that are from the US. And I've kind of like, I'm looking at firms based upon their extensive margin in CompuStat and trying to get a gauge exactly for what the magnitude of that effect would have been with regard to the propensity for a firm to be kind of an exporter. So it definitely, I can pretty safely say, I think, that like qualitatively, so with that reform, you kind of increase the tax rate on exporters and it drops the fraction of exporters. And the idea is like, I'm going to try to kind of see exactly what the quantitative magnitude of that drop is in the data relative to the model. So then we can kind of put a little bit more, I can kind of come up with a better, counter to the point that you raised, but that's still kind of a work in progress.
Fair enough. I guess it sounds to me like this graph is where a lot of the action and the aggregate results is coming from. So I think, my guess is I think it's going to be important to make this as convincing as possible.
No, absolutely.
And also on that note, I think you probably have a graph of this, but it would be probably nice to see a version of this for the alternative models. Say the frictionless or what have you, just to get
sure.
So you can kind of hammer that point home that a lot of the difference between these model specifications is coming through how they are affecting these extensive margin.
Gotcha. No, that's a good point. Okay. No, thanks very much.
Can you translate this into trade flows? Like, do exports fall by 15% in the first year or 30%?
Yeah, that's something I could do also.
Like, because if really those things are moving so much, then any sort of discussion of tax reforms, future tax reforms, should be just moving exports and imports around a lot through these decisions, since those are forward-looking decisions.
Oh, absolutely. No, thanks. That's helpful. Yeah. Thanks, guys. No, these are really helpful comments.
Well, great. I think we'll stop recording at this point, and anyone who wants to hang out a little bit longer should feel free to do that. Next week, I think we have somebody else talking.
Ellen Heltman, according to the...
Yes, sorry. That's the next one, right. Ellen Heltman next week. Don't tell them I said somebody else. And then following that, we have Carter Mix. So we'll reconvene next week. Thanks so much, Adam.
Thank you very much for having me, and thanks everybody for all your comments. It's it's really helpful. I appreciate it a lot.
Great.